Don't buy CIBC stock until you watch this video. Yes, that was the title, and no, this is not clickbait. This is all about reading charts, and what we're currently seeing with their chart shows to us that we should hold off on buying their stock for at least between 15 and 25 days, and this is why. Let's get down, let's check it out. So this actually formed over 21 days, so in theory it should take about 21 days for it to basically happen and work out. So that is the scary part. So about 15 to 25 days might be a good trading range to see where this is going to go. So this is what's called a head and shoulders. Essentially what we have is along the same plane, we have a small mound with a bigger mound with a smaller mound. I also call this the middle finger because it's like if the Simpsons are holding up their middle finger, means that it's going to be going down. We also see this broke below that bottom trend line, and we also seen that this is now broken down past the long-term trend lines as well. So this could mean some downwards pressure. We also see this happening with high volume, and we've also seen a massive uptick in the CIBC stock as well. CIBC has outperformed most other stocks over the past 2 to 3 months, and this is of course great news, but anytime that a stock goes up, it needs to go back down a little bit and correct, and of course trade within a range. Now of course this is trading in a range, but it did dip below the range, which means that of course there are two things essentially happening here, and it is something to really keep an eye on. But when we do start investing back into CIBC, there are a few reasons as to why. Of course, if the stock price goes down, so does the PE ratio, which means that it's going to be a cheaper bank stock. It may even be cheaper than TD and eventually. It's not right now, however. It also has a 4% dividend, but if we see a little bit of a pullback, that dividend will go up. And of course, there are a lot of people who say, oh, I just invest all the time, it doesn't matter, just throw my money in and see what happens in with the bank stocks because they'll always eventually go up and they'll always pay a dividend and it doesn't really matter. And I side with those thoughts, but if you can hold on to your money for 20 days, right, and then buy in when it's lower, get a higher dividend percentage over time, it's worth holding on to it for 20 days and just wait and then buy into it later. Of course, what happens in past performance is never a guarantee what happens in the future, but at the same time, whenever we see head and shoulders patterns, there is a high probability and high likelihood that that pattern means that there's going to be downside. The other great thing about CIBC as to why we would buy it in the future is, of course, the dividend growth. The dividend growth has been really good. Of course, it's been frozen at $1.46 for a while now. Usually, as we can see, that either once a year or twice a year, we'll see dividend raises, and that's something that we do see with CIBC. However, currently, they are unable to raise their dividends mainly because of COVID-19 right now, and they have been told that they are not allowed to raise dividends, which means that, of course, if we can get a dividend at higher than 4%, and then when they are finally able to raise their dividends, they make a massive jump, like a 5 to 10, maybe even 15% raise on their dividend, we're going to be seeing that here. And if they do a 10% dividend increase, you're going to be looking at $1.60 per share in the future, or maybe even the near future, maybe first quarter of next year potentially. We've also seen some very good earnings over the past 4 quarters. They have outperformed each of the 4 quarters, which is great news. However, because of this head and shoulders, anytime you see a head and shoulders, it's usually a good factor just to hold on and see if it does go down. Now, whenever a pattern forms over a certain amount of time, so for example, this was 21 days, this may be a downwards trend for 21 days. We may be able to pick this stock up for about 140, maybe even 138. Somewhere in this range, I would say that this stock will travel to within the next about 21-ish days. Now, if that was to happen, this would be a fantastic buy. If we can see even a 1 to 1.5% decrease to this stock price, that will allow us to make an extra 1 to 1.5%, maybe even 2% when it starts to tick back upwards, but also we will be able to make a higher percentage over time on that dividend. So even though you may just miss one dividend time, you're really not missing out on a ton. So for example, if you waited until it came down and you're getting maybe a 4.1% or 4.25%, if you're holding it long term, that's going to make you more money than if you were to invest in it today, try and get maybe a $14 dividend on 10 shares. Then in the long term, you're better off just waiting a couple of days. This is my own thoughts. Never trust a random YouTuber on the internet. Always do your own research. I hope that this video has helped you become a better investor. If it has, hit that like button, subscribe, and I'll see you guys in my next video.